Day one of the 21 days of property investing, we're looking at the foundational 3 C's you need to know whether you're looking to buy your first or your 10th property. These 3 C's are going to save you a lot of heartache, and it's going to make sure you can keep growing your property portfolio. Number one, probably the most important, is cash flow. You need to understand how the money works in property investing, how money flows through. It's essentially a business when you own a property investment, and that expenses are going to come out and then you're going to get a net return. And it's 3 very important differentiations, but when you have a cash flow property overlay onto an investment: negative cash flow, neutral cash flow, and positive cash flow. Let's go through them really quick. Negative cash flow is when you have to keep putting money into the deal even after you own it. And this means the rent is not covering the expenses each week. Now, obviously not a good situation long term, and it only should be done strategically if you're owning that property to add value to it, and then it will be more cash flow positive in the future. Maybe it's a development potential or land bank potential, so you're happy to wear the loss short term because of that long term play. Ideally, we want to get in a situation where at least break even. So rent is covering the mortgage, insurance, and rates costs, and at least you're saving the hassle of having to put in extra money each week. This is often achieved, especially in better locations, using interest-only lending and just making sure there's enough equity in a deal. Ideal scenario we're getting is we've got positive cash flow. That means that the rent less the expenses is giving you money in your pocket each week, and you can decide whether you want to put that back into the mortgage or into another investment or just build up savings. So cash flow being the most important part of building a big portfolio, because if you're not making money from your investments, it's very hard to buy more, and certainly the banks are not going to lend you more money if you've got a negative cash flow situation. Number 2 is capital gains. So this is where we're looking at buy properties in better locations, better types of properties, and we're looking at properties in areas where maybe the property cycle has dipped, and you're getting a situation where you can see that values are going to go up. So capital gains is a very important thing. You want to look at the historical figures of the location and type of property you're looking at, and understand that that is going to influence the probable capital gains in the future. Now, we also need to have a look not just at historical things, future things, like are there roads, infrastructure, transport things going to influence the value of this property in the future? Are there certain industrial things to take into account, like is there a mill closing or opening? Is there a school opening or closing? These things are going to influence the return, the value uplift on a property. Number 3, capital improvement. If you're serious about building a big property portfolio, you need to add value. Going in, buying a property and sitting on it forever, it's not the way to build a big portfolio. If you're not adding value through renovations and maybe it's like adding bedrooms or bathrooms or kitchens, or you're splitting the property up, things like that, it's going to be very hard to build a big property portfolio, and certainly it's going to take a long time. So combining these things is going to be what sets you apart if you're serious about going past 2 or 3 properties and getting that 10 plus property portfolio range. So you want to understand areas and opportunities of arbitrage. That's where you're seeing properties that you can buy at a discount to their value, because maybe the seller is desperate, needs to move something on, or they don't understand the potential of their property. And we'll go into those details in later lessons. And you need to understand the timeline for adding value. If it's going to take 1 or 2 years to add the value, and you're going to have to go without income, rental income over that time, you need to understand, have you got enough equity to get through that scenario? So combining these things is what is going to create an advantage for you as a property investor. Think about meatloaf, 2 out of 3 ain't bad. You want to combine cash flow and capital gains, or cash flow and capital improvement, or capital improvement, capital gains. Trying to mold these things together, at least 2 out of the 3 is going to be the thing that creates the momentum for building a bigger portfolio. Too many people have been only getting 1 or not even achieving 1 of these 3 things when they've been buying properties. Certainly over the last few years, some people have been buying some new build properties on the outskirts of cities, not really achieving cash flow, not really getting themselves a good capital gains opportunity. And certainly when you're buying new build properties, very, very hard to add value. there's a small bit of land, it's a new house, there's no way to add bedrooms or change the kitchen to bump the cash flow up and create equity. So you need to understand that inverting this problem is a good way to think about it too. What would be a poor cash flow property? What would be a poor capital gains property? What would be a property that doesn't have much capital improvement opportunity? Think about the problem the other way around, and that's going to help you think about how to find properties that do have these opportunities. So focus on the 3 C's, and when you're looking at properties and setting up your filters on the real estate sites, understand that achieving these things and getting it right when you're buying properties is going to help you build a bigger portfolio into the future. Day 2 of the 21 days of property investing, we're looking at the hidden C's. There's 2 more building on the 3 C's from yesterday. We're looking at capacity and commitment. Now, capacity is your borrowing power. How much can you borrow to buy this next property? And if you're tapped out, you can't borrow the money yourself, then what can you do about it? Where can you get the money to keep taking action on that next property investment? Sometimes you're going to have to look at joint ventures, trades, or partnerships to keep taking steps in your property investment journey. So maybe you've got 2 properties, you want to buy a third, you don't have the equity, you don't have the borrowing power. You're going to have to start looking at joint ventures with friends or family or other investors as part of your community group, like we've got in the Property Formula Workshop. Maybe you've got to look at a trade, something that you can buy using a short-term finance option. Maybe it's like an 8-week renovation project. You're not able to keep it. The whole investment strategy is to buy under value, add value, and flick it on for a profit and pay off that finance. Maybe you're looking at a partnership option, something a little bit more long-term. Maybe you know somebody that has a land bank opportunity, but they don't know how to develop it. Maybe you can help with the numbers and help bring in other investors and take a little bit of slice of the action. There's always capacity to do something. Having the excuse of not enough income or borrowing power is, that's just an excuse. Commitment, this is the 5th C, very important. You want to understand your end game. Where do you want to get to in 10 or 20 years' time? You have to understand that that's going to be 100 steps, and it's very important that you make momentum on each step as quickly as you can. So how much time commitment can you put into it? In the earlier years, maybe you've got to put a lot of time commitment into the knowledge side of things or into making offers. And this is where your action is so important. Some people have a lot of passion. They say that they want to build a big property portfolio, but in their bank account and in how they spend their time in their calendar, it's evident that they're actually not putting that desire into action. So this is where it's very important to understand that sometimes you're going to have to give things up. You're going to have to sacrifice things like, I don't play rugby anymore. I don't go to the gym as many times a week as I used to. I don't see my friends as much as I used to. Yeah, those are sacrifices that you have to be willing to make if you're serious about building a bigger portfolio and building up a bigger investment asset base. Sacrifice is often the action step you need to take to create the time and space and headspace that you need to take and make progress on your asset base. And this comes back to saving as well. Are you saving 1% of your income, 10% of your income, 50% of your income? Are you actually serious about building wealth and building a portfolio? Because a lot of people are actually spending more than their income. They want to build a portfolio, but their money actions and money habits are not actually evident. So you got to understand what your goals are, how you can execute on them, and the important thing is you have to make offers. If you're not making offers on properties, then it's evident that you're not going to build up a portfolio. Making offers, even lowball offers, if you're making 100 offers, something's going to hit. And if you're not making offers, it's because you don't have the knowledge. You're scared about what's going to happen. You don't know what number to offer. So you haven't actually demonstrated that you've got that commitment. And this comes back to what you're doing now, is building up your knowledge base. And all your spare time, if you are not making offers and you're serious about a property portfolio, should be going into learning more through our content and other local content and Bigger Pockets. There's plenty of free information out there. Now, what's really important is to understand that if your commitment level goes up and down, which is pretty normal, that your partner, your friends, your family, they're going to be naysayers. It's going to be a point where they're going to try and give you the ability to like grab onto your excuses and have delays, and they want to distract you. You have to understand that sometimes friends and family are not going to support you in your goals, and you're going to have to push past that. You're going to have the ultimate kind of discipline to sacrifice on the things that you really love to do, because you're really long-term focused. And it's super tough when you're just getting started, or when you're at a natural sticking point. Maybe you're 2 or 3 years away from buying a property and you'd like to bring that back to being 1 year. That's going to mean a lot of sacrifice. It's the same for people that have 2 or 3 properties and they want to get to 5. Might involve a lot of sacrifice, and that does mean less time for things that we love doing. So understand that this is all very normal. Having an understanding of your commitment level and trying to bring your partner and family along for the journey. If they're not going to be there, then you're going to have to do it on your own, and you're going to have a lot of knowledge so that you can have confidence in what action you're taking, and that when they try to bring you down, you're still going to be able to push past that. So understand capacity and commitment, and that it really is in your hands to take the next steps. Day 3 of the 21 days of property investing, we're looking at a case study where an investor made over $500,000 through one property. So we're looking at purchasing at a discount a boarding house in Wadestown, just out of Wellington, and we can see the purchase price $810,000, renovations $160,000. So this was done very quickly after purchase. And we can see total costs, the legals and other associated costs, $977,724. Now, the interesting part was a $1.1 million valuation after all this was done. So we can see $122,276 of equity uplift in a very short period of time after the purchase was made. So a great buy from a capital gains point of view. We can see that the rental income, $1,650 a week. We anticipate a 5% vacancy, which is netting this owner over $34,000 a year of income. And because this mortgage was taken at a time where it was a lower rate and it was taken on interest only, this investor maximized the purchase for the cash flow. So we're getting capital gains and the cash flow. So go back to day 1 if you want to learn about the 3 C's. So what we've seen is a capital gains improvement through a discounted purchase price, cash flow because the rental yield is high, and capital improvement where they've added value, and this is how they've unlocked that equity growth. So cash on cash return is close to 37%. The gross yield 8.8%, and mortgage coverage, which we'll learn more about in the property formula workshop, is we want to see this mortgage coverage amount getting closer to 10-11%, because then what that does is allows us to keep borrowing more money for more purchases. And the reason that this number comes down is if you leverage up. So this investor wanted to keep purchasing more properties, so they took the mortgage to the 80% of this final valuation number. So they're really looking to maximize their return on cash. The net yield 5.2%. after topping up. So again, they've got an equity gain, they maximize it for cash flow, that pulled their money back out so they can recycle it into more investments. And then factoring in just a 2% capital gain over the next 10 years, we can see that with the income and the capital gain, this property is going to make this client over $500,000 in value into their pocket over the next 10 years. So you can see, just with one property, intelligent buying, and knowing what you're doing, it really is easy to unlock that value add for yourself. And if you're looking at properties that don't provide cash flow, capital gains, or you don't see any value add, then probably not the right investments for you. So case study, there's more details in the email. Stay tuned for day 4. Day 4 of the 21 days of property investing, we're looking at the BRRR strategy. This was made popular by Bigger Pockets in America, but the principle still applies here in New Zealand. So the BRRR is an acronym for buy, reno, rent, refinance, and repeat. So if you want to build a big portfolio, you need to understand that the buying process, it needs to be structured and well thought out. You can't just make an offer on a property, get that under contract, and set and forget. To get a really good buy under your belt, you're probably going to have to make 50 or 100 offers. You need a structured process for making offers. Understanding that if you're looking at, say, $800,000 properties and you're offering $650,000 for those properties, most of those offers are going to get rejected, certainly in a hotter market. But a few of them might stick, and with the right clauses, like a due diligence clause or builder's report or some clause, you might actually be able to get some of those properties under contract for $650, even though they've got a CV of $800. And then you might get to a point where you've made 50 odd offers, you got 10 accepted, you go through due diligence, and then you end up deciding to go unconditional on only one of them. It might take you a whole year of making offers every week before you get to that one where you go unconditional. And so having a buying process is really important. You understand the legal side of things and how to make offers quickly. It might only take you 5 to 10 minutes using a digital signature process to make an offer and get it in the agent's inbox. The reno side of things, you need to have an eye for detail on whether the property needs bedrooms or bathrooms or garage or storage, kitchen, street appeal, little things that on their own might not add as much value, but by spending $1,000 here, $5,000 there, $10,000 there, you can understand not only just the numbers, but the aesthetics and the outcome of spending the money, because there's kind of like this magic number with renovations. You really want to spend $1 and get at least $3 of equity uplift, and then also taking into account the cash flow side of things. Rent, again, another important thing to understand, that the rental side of the equation, you need to see where the market has mispriced. It might be that the agent that's selling the property or anyone that's associated with that property thinks maybe the rent's only $420, but you can see with a little bit of extra work you can get $500 a week for that property. So it might be that you're getting appraisals from different property managers. It might be that you're managing it yourself to maximize the cash flow on the rental side of things. Refinancing, if you're just getting started in the investment side of the game, what usually happens is people buy their first home and convert it into an investment property. That can maximize your leverage, because owner occupied, you can go up to 80%, but the investment side of things is not as easy to get 80%. So starting with that intention of buying one property and then building a portfolio by shifting houses is a pretty common technique. And understand that if you're refinancing, doing your calculations on interest only lending and not paying down the debt is the way to focus on building your asset base rather than paying off your debt. And also in New Zealand, we've got non-bank lenders. So it might be that the bank doesn't allow you to borrow as much as you want, especially as you keep building up your portfolio. But there are specialist property investment lenders that focus on allowing you to go up to a higher LVR percentage, and you just factor in those costs in your calculations. And this is the important process, is how quickly can you repeat? Are you going to have to flip or trade properties, or can you keep a property and keep building your portfolio on that? Bearing in mind that there might be a golden ratio. If you flip or trade 2 or 3 properties for every one that you keep, it might be that you flip 4 or 5 properties for every one that you keep. It depends on your income situation and how quickly you want to grow. So you have to understand that repeating this process is about going back to this offer stage and getting more properties under contract than you can actually settle on yourself, so you can assign those properties, and we'll cover that in future episodes. But you really want to have an overflow of opportunity for yourself with property investments that have equity and growth in them, so that you're effectively missing out on opportunities rather than feeling desperate that you've got to jump on everyone that you find. So this is the BRRR strategy, and if you want to dive deeper into some of this, you can join up to the Property Formula Workshop. Day 5 of the 21 days of property investing, we're looking at house hacking and multi-income. The key principle you need to keep in mind if you really want to build a property portfolio is adding value is going to be the trick. If you're buying properties where you can't really add any value, it's super hard to build up the equity quickly that you can get to that bigger portfolio. So understanding that capital gains make you wealthy over the long term, cash flow liberates you, gives you a bit of time freedom and money freedom, but the capital improvement accelerates this process. Value added through house hacking is the name of the game. That's adding bedrooms, subdivision. It's these where you're basically requiring tradesmen or professional services people to do some work for you. So adding borders, renting your properties out room by room, minor dwellings like little sheds out in the back, might not even have bathrooms or kitchens, but somebody can rent that relatively cheap. Maybe you separate your properties by floor or cut them in half in some way. You have to understand that maximizing the rental income is super important, as well as the capital improvement side of things. So home and income properties is a very common way, especially in the early days of building up that big portfolio. Maybe you buy a 3-bedroom with a one on the side, so it's separate tenancies that get you a maximum return. A 4 and 2 scenario, you see this with a lot of immigrant families. They have a bigger group, but they have separate properties on the same title because it's important that they stay together, especially with the new rules around what requires consent and what doesn't. You can look at tiny homes, relocatables, and things that are on wheels that are movable, and you can place them on your property and start generating extra income quickly. You can also, the extra for experts, you might look to support the tenants with a few other things like appliances, furniture, or storage. And these are things that you spend your money on. You might get them cheap, and you can add a little bit of extra on the rental side of things. You want to understand that certainly in the beginning, if you buy a home and income property as your first property, then that gives you a little bit of arbitrage. You can go to 80% lending, essentially on 2 properties. You live there yourself, rent out the other side, and so some of your mortgage costs are supported by a tenant right from the beginning. And then when you move out, then you now have 2 investment properties. So house hacking and multi-income properties, definitely a thing to think about for your property investment journey. And it helps default you away from the easy investing like new builds. Day 6 of the 21 days of property investing, we're looking at the next level strategies for when you get stuck out on investing yourself. You want to be looking at these strategies to keep pushing your portfolio forward. So joint ventures, trading, flipping, and double settlements, they're all different takes of the same thing. Basically, you want to have deal flow, and you want to slot in other people where it makes sense. So if you're running out of borrowing power, joint ventures is when you're combining the skills of usually 2 to 3 people that are bringing different things to the table. So maybe somebody has good skills with their hands, somebody has a good deal finding skill, and some people, they just bring money to the table. So you want to combine those people into buying one property or a group of properties, and then you work out a profit split arrangement. This brings accountability. It doesn't have to be equal partnership or equal profits. It's all kind of a negotiation, and this is good for friends, family, and other investors. And it's certainly a tactic we talk about in the Property Formula Workshop, where investors who are like-minded that might not know each other come together in a group, and because there's the central advisory partner, they start working together. Trading is another tactic where you can look into staged ownership, where you might access a property that you've got under contract early and do some work on it. You take over the ownership of that property and you settle it, but you're not intending to own it for very long. So this is where you might see something that's presented poorly by an agent or a vendor. You can see that with a bit of extra staging, a little bit of cosmetic and quick work, you can relist that property, and you're only financing it for a short term, so it is expensive finance, and it might be that you're not even able to retain ownership of that property. The finance is really just only for 3 to 6 months. You're seeing an arbitrage opportunity where you can maybe make $30,000-$50,000 of net profit because somebody else hasn't seen what you've seen. It's a little bit different to flipping properties where you do the BRRRR strategy we talked about before, but instead of refinancing it, you're selling it. This is where you're doing more of a full reno. You're looking at, you have to make sure you really understand the full costs and tainting side of things. And it might be that you need to understand that it is a longer process. The renovation might be 2 to 6 months, might even be up to 12 months, and that you've factored that in. Double settlement or assignment, there's different ways at looking at this, but basically you're wholesaling properties, or you're getting something under contract and settling it contemporaneously, or you're just putting somebody else's name on it and adding a fee. So you need to understand how dangerous it is to go unconditional on something if you haven't assigned it, and that also assigning something that's conditional, you really got to make sure you know what you're doing with your lawyer and other people. Probably you want to be working with somebody that's done it before. Maybe you find an opportunity, you take it to them, let them make a whole bunch of money on it, learn the process, and then you've got a skill that you can apply for the rest of your life. So it is high risk reward. All of these have different risks and rewards, but they allow you to get rid of that excuse of not having any borrowing power, because it gives you the ability to keep investing without actually focusing on trying to keep that property in your portfolio. It's just about creating equity for yourself to invest in that property later on that you eventually do keep. Day 7 of the 21 days of property investing. We're a third of the way through now. We're looking at avoiding failures and costly mistakes. So creating financial freedom, it's a long-term game. You can make momentum quickly. Just understand it is a 10 to 20 year play. And remember the first 2 rules of investing from Uncle Warren. First one is don't lose money, and the second rule is don't forget the first rule. So the main reasons for failure and loss in investing is that the preconceptions and past experience. Property investing, it is a risky game sometimes, and you have to understand there's going to be things that don't go your way. So if you've had that in the past, you've got to push ahead anyway and understand that the last deal isn't going to be how the next deal goes, and you got to get through that. Short-term thinking is really going to break you. You have to have that medium-term, long-term thinking when it comes to investing. Building up that portfolio, the reason that we're doing it, you've got to understand your why. Unclear goals, again, we need to make sure that we remind ourselves of our goals. The goal is not activity, the goal is creating income for life. Reacting and waiting, you've got to understand there's always things you can be doing for property investing, whether it's talking to agents, looking at listings, especially the dated listings, reading, learning. There's so many things you can be doing with investing, and it might even be that you're contributing and helping other investors, and through teaching them, you're learning more yourself. Numbers versus emotion. The people that I've seen get the most stuck are the ones that are investing emotionally and not with the numbers. They might be looking at a particular area of investment or a type of investment. They've got this emotional feeling about that, and it holds them back without looking at the numbers. Doing things yourself, again, can slow you down a lot. Even if you know how to change a door or sand a wall and paint it yourself, doesn't mean you necessarily have to do it. But the same with the numbers and the legals and the accounting side of things. Doing things yourself often doesn't make sense. You might save $1,000 here and there, but what you end up doing is building a smaller portfolio because you spend less time on the big stuff. Just like if you ask a barber if you need a haircut, they're going to say yes. You ask how would a plumber or a lawyer react if you try to do that work yourself, is probably they'll laugh in your face. And it's the same when it comes to the mortgage and accounting and legal side of things on the property investing side. Don't try to do all these things yourself. Focus on finding the right properties, getting them under contract, and doing the heavy lifting stuff, and leave some of the detailed stuff to the experts. And I guess the important thing is to make sure that you're protected through this borrowing journey. An investment journey requires you to leverage, and understanding that through that leverage journey, there's going to be things in your life that are unpredicted, like medical, illness, income breaks, things like that. Making sure you've got the right insurance through this borrowing journey is going to make sure that it's a smoother journey and you're more likely to reach that goal. So if you want to avoid failure and costly mistakes, some of the the boring, less fun details, you've got to make sure you get right. And if you know how to find the right properties, that's the number one skill. Day 8 of the 21 days of property investing, we're looking at how to maximize your returns by focusing and understanding your borrowing power. So the thing you need to understand is that the borrowing options between the different banks varies significantly. One bank might lend you $600,000, another $800,000, another bank a different number altogether. And this information changes all the time. Test rates and the way that they look at things like cars, dependents, age, your Kiwis saver contributions. They assess your current loan costs, and sometimes they assess them based on the cost to you or at a certain rate or a payment amount. And they will look at your income type, whether you're a contractor, self-employed, or PAYE. All those things play a factor into your borrowing power. So you need to understand banks are different, and that if you haven't had an assessment on your borrowing power in the last couple of months, it's always worth checking in before you start getting, in a box about your borrowing options. If you're going to be building a property portfolio, you need to understand that non-bank lenders might play a big part. So non-bank lenders are specialized for property investors. They're fast turnarounds and they can be quite pragmatic. It means they make intelligent decisions based on the property, not necessarily on the whole picture. So if you can present to them a good case, they can tap their institutional or private funding and you can get the money. So these non-bank lenders can help you get into a property where a bank might say no, and this non-bank lender might be there for a month or 6 or 12 or 24 months, and you can look to refinance back with the main bank, or you can roll that into getting another property. So if you want to understand how to free up your borrowing power, increase your borrowing power, understand that friends and family might be quite helpful, that rental income plays a big part. So if you've got a 5% yield or a 6% yield or a 7% yield on that investment property you're looking to buy, that's going to impact your borrowing power as well. Refinancing and restructuring is often the key. If you already own properties and you want to buy another property, you can unlock equity and borrowing power by lengthening terms and topping up mortgages, and converting things from principal and interest to interest only is going to make a big difference. Your income type might be worth considering switching from self-employed to PAYE, or from a contractor to your own business, declaring income in different ways, claiming expenses in different ways, understanding that the tax man, your accountant, the mortgage advisor, and the bank, they all have their own perspectives, and showing what you need to show on your financials or your income declaration is very important. Expense management. Before you go to borrow money 3 to 6 months out, you want to make sure that you're bringing your expenses down, lifestyle costs, bring them down below the minimums for assessment, and this is going to help push up your borrowing power. So certainly if you're looking to build a property portfolio over a 10-year period, you want to be really checking in with your mortgage advisor, getting your spreadsheets updated, getting an assessment or an approval updated so that you always got ammunition to go out and buy. You don't have to have a pre-approval. You can have what I like to call pre-qualification as a borrowing power calculation on the spreadsheet. And you can bring a prospective purchase to your advisor and say, hey, look, I want to get this under contract for this amount. This is going to be the rental income. Can you make it work? Understand, borrowing power is a dynamic and moving beast, and working with experts and a lot of different lenders is going to give you a lot more options. Day 9 of the 21 days of property investing, we're looking at where to buy. And the mistake you can make on where to buy is focusing on regionally or a town or a city. What you should focus on is where can you buy based on your borrowing power and the yield, and that will help you form your decision-making process. So based on your borrowing power, you're going to have a budget, say it's $800,000. And my suggestion is don't max out your leverage. So if you've got an $800,000 maximum borrowing power based on a certain yield on a property, focus on properties that are maybe 650 to 700. So you've got a little bit of ammunition left that's going to help you get the money you need for renovations. And also it's going to make buying the property after this one a lot easier. Once you've got understanding of the numbers, like the gross yield, which is your annual rental income over the total cost, and then your net yield, which is your profits, can start factoring in consideration like your mortgage coverage. So if you want to maximize your borrowing, you've got to understand that your mortgage coverage, which is the annual rental over the mortgage amount, basically is going to come down. So the less equity you have in a deal, the less borrowing power you're going to have later. So having more equity in your portfolio allows you to keep borrowing, and vice versa. Cash on cash return is just your return based on what money you've got invested in the deal. Again, also an important consideration to keep an eye on in the spreadsheet. So when you're deciding where to buy, you want to be looking at places where you understand the industry, the population size is big enough to justify that a lender is going to give you the money. You know what trends are going on in that place. You've got a knowledge of that area. You have to understand that if you're investing in an outside area, let's say you're in Auckland and you want to invest in Ashburton, you're essentially saying to the people in Ashburton, I know more based on the numbers than you do, and that's why I'm able to buy that property and pay higher than you would even as a local with that local knowledge. So you have to be confident that you're not the sucker, that those locals in Ashburton are laughing at you being an Auckland investor overpaying unless you've got numbers to justify your decisions. Deciding where to buy is also, you want to factor in the types of investments you're looking at before you decide where. Maybe you're looking at holiday accommodation and Rotorua is something that you're looking at and you're making a decision based on that, and that's totally fine. As a rental property, it might not work, a property in Rotorua, but as a holiday accommodation, Airbnb, it might cash flow 15% plus. So that's where taking a different perspective is important. And we want to be thinking about not just using the past to make our assumptions about capital gains, but the future infrastructure development. Is there new roads, new universities or hospitals? Are there things going in or coming out that are going to impact the values of the regions you're looking at? And certainly, because we're yield-based investors, you're probably not going to be looking in these major metro areas because that's going to limit your portfolio growth unless you have a really high income. So we're going to be investing in areas maybe you're going to have to learn a lot about that you don't know much about. Maybe you've been a Rotorua once or twice in your life and you're going to have to really double down and learn a lot about it. Places, an hour out of Christchurch, an hour out of Nelson, maybe Nelson, the second ring. There's a lot of areas around the country you can learn about. And if you want to build a big portfolio, you really need to focus on yield, unless you're, in that 1% with the 500K plus income to begin with. So where to buy is based on the numbers, and then you start looking at areas that fit your calculation requirements. Financial freedom. Day 10 of the 21 days of property investing. Today we're looking at what to buy. There's so many different types of property investments. We've got apartments, units, if you're buying your first home in the suburbs, boarding houses, commercial, industrial, home and income, land, cross lease, new build. That's just a small selection of the options available to you. And then over and above all of that, we can look at new versus existing, central versus rural, local versus far away, small versus large, proven areas, not proven areas. There's so many different variables. That's why it can get quite confusing about what to buy. So my suggestion is to do high level research on each of these things and start crossing things off your list. Start with a list of say 20, 30 options. Start crossing things off your list. Like you'd cross leasehold off your list, unless you're one of those weirdos that wants to take that risk on the costs ballooning there. Maybe you don't want to do the research on apartments. You don't like the low yields of new builds. So once you build that big list and start crossing things off, you're going to be left with a much smaller list through the process of elimination. And remember that using the 3 C's, we want to find investments that have value added optionality and that fit within our budget unless we're working with partners. And when you get to a point where you've narrowed down your search to maybe 3 or 4 different property types, you've got your filters working on the real estate sites, you're starting to look for hidden value, what you can finance, what's in your budget, and then understanding, are you going to be able to do this purchase on your own, or do you need partners? Because ideally you want to be good at spotting opportunity within the niche of what you've decided to buy, and you can act with speed. So I can't tell you what to buy because that's going to be based on your experience and what is of interest to you. I would say start with a big list and narrow it down. Financial freedom. Day 11 of the 21 days of property investing. Today we're looking at how to buy.
Now, there's 4 main ways to buy property in New Zealand, but mostly it's going to be auctions and negotiation. It's important you know what to think and how to think when you get to a property that you like, depending on what that sale method is, to know what to do next. So you want to understand the mindset with property investing has to be that you shouldn't have a fear of missing out, because there's always tomorrow's deal. And if you want a particular property too much, it can make things emotional. You can start doing things that are not logical based on the numbers. So long-term focus and understanding that FOMO is going to cause you to make mistakes. So negotiation, that's going to be our favorite kind of method probably for most property investors, because it gives us the ability to do the pre-work and have very little cost, so we can make lots of offers without too much risk or cost or time associated with those offers. So negotiation allows us to do speed offers, like lots of offers quickly when properties come onto the market, and then we can do research. So negotiation, very little cost, the risk to make offers is low. You want to get to a point where you can make conditional offers on properties, which is get properties under contract in as little as 10 minutes using a due diligence clause or any clauses that you feel are appropriate. So with negotiation, you want to be looking at listings as they're fresh. So when they come onto the market, you're making offers quickly, and that gives you kind of front of the line options. And with negotiation, also a model that can work is if you see a property that's been on the market for a long time, then you can do lowball offers, and you might get a vendor that's getting impatient or getting desperate, and they'll take an offer that they wouldn't have accepted 6 months ago, but that they'll consider now. So the trick that what a lot of people get stuck on with making offers on properties is they want to go and visit the property first, have a little look and see around, and then make an offer. What that does is that it takes up a lot of your time. It doesn't take many weekends of visiting 3 or 4 properties each Saturday and Sunday before you realize that you're burning through 10, 20 hours a month just going to visit properties, and you're not making offers. And you're visiting properties, getting a price indication, making an offer, but you're actually like quite far apart where you need to be. So the time invested in visiting the property is actually not serving you. So what you really want to get into the habit of, if you can, is making an offer on a property, getting it under contract, and then go visit it. Because we're not trying to get emotionally attached to this property. If it's an investment, we can see the photos, we can do our online research, looking at Relab, looking at the valuation reports and homes.co.nz. We can make a numbers-based offer, and if that offer gets considered or accepted, then you can invest the time to go and look at the property. That is not what an agent is going to suggest you do, and it's certainly not the typical approach for like a home buyer, like somebody who wants to buy a family home. But we are property investors. Making an offer before you visit is totally within reason. Now, auction is the highest bidder wins. You have to understand that when you're going to auction, if you're putting your hand up and winning, that you have gone unconditional. So that means that you're taking a higher risk, and it means that your research needs to be done before you go under contract. As opposed to with negotiation, you can get a conditional contract, maybe 10, 15, 20 days of due diligence. You can do your research after you've agreed on a price and terms. With auction, it's the other way around. You got to do all that homework up front, and you got to make sure you're prepared to meet the obligations of that number. So this has pros and cons. The pro being that other investors have to wear those costs too. So if you've done the work and you get a property under contract at that right price, then it forces the other investors to compete in that way. But the con being that there can be a lot of work and cost assumed and done before the auction, then you're not successful. So if reserves not met, there's a failed sale, and you're the highest bidder, that's going to put you in a position to negotiate with the agent and the vendor. So that's an advantage. But typically, it's more advanced for experts doing auctions and going unconditional properties in a lowball kind of way. You have to be a little bit more confident. So for most property investors in the beginning of their portfolio building journey, you can keep an eye on auctions, especially if they fall through, and take advantage of those opportunities. But negotiation is going to be more of your friend as you get going. And you want to be looking for properties that had unconsented work or desperate sellers. That little curveball is going to knock other potential buyers out of the way. If you can work with those kind of difficult things and get around them, that puts you at a greater advantage. Tender is another thing that's used, especially with properties outside of Auckland a lot, where they're kind of getting interest from the market. They want you to put your best foot forward. You have to understand that agents are going to push you to make unconditional tender offers. You don't have to do that. You can do a conditional tender, understanding that due diligence costs money and time, and you want to put yourself in the race. It might be that you're the only one that makes it an offer, or that your conditional offer backed with the information you supply, it might be lower than another offer that's higher, but with your terms and because of the credibility you add into your offer, you might be able to be the front runner. So conditional tender offers are something you want to have a look at. And private sales give you the opportunity to meet with the seller directly, meet and greet. You can have coffee, you can discuss things on your own, and it gives you a great ability to start dealing with someone that might be trying to cut costs or that doesn't understand what's the real value of the property. So again, looking at private sales is the way to go, and it might be that you're not finding those private sales on the traditional places or Trade Me and real estate. They might be on different listing sites. So don't be scared by any of the methods. Keep an open mind and understand that how to buy a property is going to be a dynamic thing. You want to get the skill of doing offers quickly in a digital way with clauses you copy and paste and digital signatures. So that it's only taking you 10 or 15 minutes to make an initial conditional offer, and that you're not being held back by having to go to the property before you understand what it's worth.
Financial freedom.
Day 12 of the 21 days of property investing, we're looking at why to buy investment properties. You have to understand we're buying investment properties to create financial freedom for ourselves. We're reversing back from that goal of having passive income, a bit of time freedom, a bit of independence. And what we're trying to do is beat the anxiety that comes with not having enough money and not achieving the financial goals we have for ourselves. As much as it is exciting to reach a point of wealth, what we're trying to do is make sure we don't have all the worry, the anxiety and stress and the embarrassment that comes with not achieving financial goals that we could achieve if we put our mind to it. So creating that independence for yourself through having financial goals ticked off gives you that extra dignity and the ability to help friends and family and spend time in a way that you want to. So we're buying investment properties to create this 100K a year passive income. There might be less, might be more, depending on your situation. And you really have to just invert the problem. How do you create financial freedom? Well, let's look at the alternatives and see why most people are going to end up, especially in New Zealand, on property. Is because the alternatives are shares, which are very hard to use leverage to get into. It just requires capital. Crypto, which depending on how you see it, is more of a higher risk opportunity, and again requires a lot more money up front, and using leverage is not a traditional thing. Business investments, more of a specialty skill. If you're making investments into businesses, you're really going to want to have operational experience or be sitting in the seat yourself. Currencies, commodities, speculation on things. These things, again, require money up front, very hard to leverage into. There's still volatility. You require a lot of knowledge that is specific. Winning lotto, not a strategy that's going to work for many people. Using your working income, your PAY income, and saving it away. And last but not least, on the main alternative options to build financial freedom is property. So you can see what happens is by default, most people are going to end up saying that the way they're going to build wealth is through property, because it gives you leveraged returns and it's a tangible asset. So buying a property, using a mortgage, it creates what we like to call forced savings. You're committing yourself over the long term to contributing into that mortgage. If the REIT doesn't come through, it's a semi-illiquid asset. So yes, you can sell a property quickly if you have to, but you're not going to be tempted to draw on those funds and draw out that money in a way where it's kind of locked away. Risk versus reward. With these things, unless you've got special knowledge or a deep dedication to learning more about them, the risks and the rewards kind of get a bit unbalanced. With property, you can see from the last 100 plus years in New Zealand, it's been a stable history of growth in that market, and there's a lot more demand globally for people who want to move into New Zealand, and there is natural population growth. And again, that property is one of those things that, because you can add value to it, and because you can buy in a discounted way when there's more desperate sellers, it is easier for most people to get a little bit of arbitrage, which is hidden value. You can buy something that's worth 800 for 750, spend 30k on a reno, and get that uplift to a value of say 880. So that's a skill that a lot of people can acquire, and you have to understand that it's a manageable stress. Property investing does carry with it certain risks and stressors, like the finance stress, the stress of trying to find the right deal, the stress of carrying through with a budget and renovations. There's stress of debt and managing the tenants, but these are all manageable stresses. You can get a property manager, you can get a mortgage advisor, you can stick to a budget, or you can buy below your means. There are many ways to manage it. With these other things, I think there's still a lot of volatility, and yes, that's a good diversification strategy, but the process of elimination leads most people, especially people that are working on PAYE incomes or contractor incomes, to stick to property as the main way they build wealth. And you just got to make sure you documented your goal. You got to have it in your head. The reason I'm pushing through these challenges is because I want to have dignity and independence in my financial future.
Financial freedom.
Day 13 of the 21 days of property investing, we're looking at when to buy. Now, if you're asking anybody, the Uber driver, the barber, if you're reading the economist reports, talking to your accountant, talking to agents and lawyers, anyone you talk to is going to have an opinion about the property market in New Zealand. And it's important to just understand, if they really knew what they're doing, they would have a $10 to $20 million portfolio. So just listen to people that already have done what you want to achieve, and you're kind of going to be in a safer space. You also have to understand that listening to someone that has a $20 million portfolio where you want to get to, they're going to have a different perspective on things, and maybe that they're going to be a little bit more risk adverse now because they're protecting what they've built rather than trying to build it up more. So you can collect information from other people and other places, but the thing is, you have to understand that the property market runs in a cycle of boom, bust, and recovery. And what you're going to see in the media and what you're going to hear from other people is averages. And the thing is, we're not buying an average property. We're looking to buy a property that's under discount, like it has a discounted price, it has a value add potential, and that you need to understand that each suburb has different fundamental attributes that are important, and that the average property market doesn't factor in the suburb that you're looking at, the property type that you're looking at, and what the future potential is. So don't get caught up in averages. Understand that the media is probably 3 to 6 months behind what's happening on the ground right now. And you have what we like to refer to as downside protection. The price that you enter into the property, the location, the type, the history, and buying and selling in the same market gives you the ability to exit out of a property you currently own. It might be at a price that's lower than you hope for, or lower than the peak amount, but you're able to buy in that same market and a discount as well. And so you can get through these booms and busts. We're buying for cash flow, for capital gains and improvement, a nice mix of all of them. And we're not buying an average property. We're educating ourselves on the fundamentals of what makes a good property investment. We're doing our research for lots of different areas about what's going on in the property cycle. And we're seeing that we're trying to buy not at the top of the market, but any other time, as long as you are holding for a 10 plus year time frame, and you're thinking 10 to 20 year mindset, even if you do buy at the top of the market and you hold through dips, peaks and troughs, you're going to be just fine. So don't get stuck on when to buy. The thing that gets most people stuck on what they don't build a big enough portfolio is they have this, I'm going to buy when, I'll buy then. You know, that they use the excuse of not right time for either based on income or based on the market cycle. If you can buy a property, you should focus on taking action, because inaction is the thing that holds people back from building a portfolio they want.
Financial freedom.
Day 14 of 21 days of property investing, we're looking at interest-only loans and working with professionals. Now, it's very important if you're a property investor, whether you're a budding investor or you already got a portfolio, understand interest-only loans. This means that we're not paying off the principal amount, we're just keeping the same loan amount and paying off the interest as we go. This allows us to borrow more, be more tax efficient, we've got better cash flow, more options because we can choose where the extra surplus cash flow goes rather than already having it pre-committed to principal. We can allocate to new investments if we want, and it has a long-term focus. So the easiest way to demonstrate this is to show you an example. So let's say we have an $800,000 purchase price on an investment, and using another property, we're going to 100% finance this purchase, $700 a week of rent. Now, if we look at just using 4.19% as a interest rate, the rate doesn't matter. What I'll show you is the difference between principal and interest and interest only. This 12-month rate brings us, if we go on to principal and interest, a $901.50 a week cost to pay to the bank on principal and interest. Now, if we switch this to interest only, then we only have to pay $645 a week. So what we can see is on interest only, we get a surplus of $55. On principal and interest, we have to contribute an extra $201.50 into this mortgage each week. So it's a negative gearing, negative cash flow. So what you have to understand is this is a smarter way to build a bigger portfolio, is to retain and maintain that debt over a long period of time. And with this surplus, you can do extra lump sum principal repayments at the end of the year, or you can put that money into an offset. You can use it as you see fit. And this allows you to manage your cash flow in a better way, that growing your property portfolio is less stressful. Now, not every property investor does it this way, but it is very common to use interest-only loans. Over 20% of New Zealand mortgages are on interest only. Sometimes it gets even closer to 30%. Very common for investors to use that. And understanding that 5, 10, 15 years of interest only is only really achieved by restructuring or refinancing. Some banks might give you a 10-year interest only term, but it's actually not very common. 3 to 5 years is more common in the current market, and that you're going to have to keep reevaluating your options. Typically, if you're paying principal on any of your mortgages, it's going to be on your family home, and you're going to keep contributing any surplus cash flow into just one property or principal and interest at any given time. And I have seen very established property investors decide to do principal and interest loans on a bunch of different properties and to say, yep, it's not the normal way and this is the way I've chosen to do it. And then later on, they come back and they reflect 10, 20 years into their journey. Actually, I made a mistake. I should have done interest only. I would have had a bigger portfolio if I'd done it that way, and I would have had better cash flow. So working with professionals, your accountant, your lawyer, your advisor, gives you the ability to understand how these different things work and to make sure that you're staying every 3 to 5 years in under a best practice, best management way using the interest-only terms. So when you're doing your calculations for an investment property purchase, running your numbers, financing 100% of the purchase and only paying interest is a good way to start to see if that property cash flows.
Financial freedom.
Day 15 of 21 days of property investing, we're looking at the realities of building equities through property investment. Now, it's very easy to get caught up looking back into the past and saying it was a lot easier to build a property portfolio back 10, 20, 30 years ago than it is today. And I do believe that's true for a number of different reasons. Look, there was a lot less competition to grow a portfolio back in the day. The ratios for income to purchase prices used to be closer to 1/3. Now they're sometimes balloon up to 1/10. So the average income to the purchase price, the debt to income ratios, you see, they've changed significantly over the last couple of decades. So there was a bit of early luck and ratio advantage for these other investors, and there was a lot less testing of income and income proof required. It used to be that you could just declare what your income was,
and the bank would give you the money based on that declaration. Now they're actually reviewing things, testing that you can actually afford it. So these LVR and debt to income restrictions do make it harder to build up a bigger portfolio these days. Now, and there's certainly more competition. There's more people recognizing that property investment is the way to build wealth. So you have to understand with online marketplaces, Trade Me and Real Estate Dakota NZ, that there's going to be a lot more eyeballs on every listing, which evens out the valuations of these properties, and it makes it that it's quite likely other people will be looking at that property when you are. Pushing past this bad luck of being born later on, if you want to build up a portfolio, you have to look at three things: adding value, spotting value, and bringing value. So adding value is going to be renovations. It's going to be looking at splitting things up on the property, whether it's levels or adding different titles, increasing the yields, and just bringing energy into the equation is going to make a massive difference on that and how you can build up your equity. Spotting value for development potential that maybe isn't being spotted by the market or by the vendor. Subdivision value, so it might be that there's 2 or 3 properties that can potentially fit on this one that you're looking at. Maybe there's been a rule change that hasn't been recognized. Quick sales, so it might be that you can buy something quickly because the vendor is desperate. They do some staging and you can list it, and you've got a little bit more patience. You can make a bit of an equity bump. And again, yield. Something might be being sold as if it was a family home. There's a very high yield potential, or vice versa. So understanding that different properties can be marketed in different ways, some to families, some to investors, and where it's misrepresented, there's opportunity there. Bringing value is when you take a real investor's mindset and a partnership mindset. Remember that property investing isn't just a single player or with you and your partner. It can be a group game. So you could bring advantages around finance and capital, around doing some of the work yourself, the reno DIY. Speed is a very big factor in property investing. If you can go fast when others can't, then you can get discounts. Access, it might be that you'll be talking to a lot of agents and you get what's called pocket listing. So you get access to a property before it goes to market. You can save the vendor the marketing costs, and it might be that you can negotiate to get something under contract faster than someone else. And this contract negotiation skills, once you really get a feel for how to do property deals, it can be through clauses or short due diligence periods, or through long settlements, that you're able to construct the deal in a way where the vendor's getting the price they want, but through your terms, you're getting a lot of arbitrage. So building equity in property investment, prices adjusted for incomes are a lot different from what they used to be, and you just need to be a little bit more creative in how do you unlock value.
Financial freedom.
Day 16 of the 21 days of property investing, we're looking at cross securities and understanding the benefits and the risks of cross securities. So cross security is when your property portfolio is lumped together, and that if you've got some lending, it's against all of your properties. Now, there's plenty of advisors and property marketers out there that say cross security is a bad thing, but understanding the benefits and the risks of cross security is an important part of building your portfolio. If you come to sell a property that is cross secured with the lending with other properties, there's going to be a potential that the bank is going to test whether you should be able to keep the proceeds of that sale, or whether you have to pay back the debt. So sooner towards the end of your property investing journey, or you get into a point where you've got a bunch of properties, cross security does create a risk. But I want you to understand that when you're building out your portfolio, there are a lot of benefits of using one lender at a time and allowing for cross security. This can reduce costs like valuations, and it can actually get you lower rates. When you split banks, sometimes it's riskier for those banks, so they won't give you the same discounts. If you find a really good banking partner or banker, it might be that banking partner makes things happen a lot faster or easier for you, and that's worth the risk of having cross security in the upward lift of your journey, because it makes your life a lot easier, and you're able to get access to things that you wouldn't. So cross security can give you options, and it creates ease in your journey.
and there's a benefit of saving money. So I do support in general separating securities, but don't get cute with yourself thinking that you're a big hotshot property investor. Focus on getting the first 2 or 3 properties. If it's all cross-secured, it's no big deal as long as the tax and ownership structures are correct and you've got the good interest-only terms locked in with low rates. Now, before you build up your portfolio, you get into a point where you're trying to assess how to structure things. There's usually no other way around it. Sometimes you have to lock. You take your mortgage on your family home, you top up, and you're going to get new debt, and then you're lumping these properties together. Now, doing that with the same bank, again, is a lot quicker. When you get to 3, 4, 5 properties, this is when understanding the moving parts is important. Because it might be that if you've got 3 properties and you want to buy this 4th property, then you're looking at options. You're looking at, okay, I've got various amounts of debt across these different properties. Should I transfer this debt over here and have this property freehold? And then I will use that property as security to buy this one, and then I'll have 2 banks in play. Or do I allow for this property to be purchased freehold without any security on it by topping up on these 3 properties, using that to buy that in cash, and there's no security on this property? So there's a lot of little considerations, nuances that a mortgage advisor is going to help you see and understand. What you need to do is plan it all the way to the end and then work with your advisor to understand those moving parts. Because what happens to a lot of people, they get a portfolio of, say, 5 properties with a couple $1 million of debt, and they get to a point where maybe their income from working has gone down, and they want a bit of cash for holidays or renovations or just life in general, and they decide, I can't top up on my mortgage to get that money, so I'm going to sell the property. Well, they get caught because they've got their portfolio all together. They sell a property to get what they think is a couple $100,000 of cash, and the bank says, hey, well, actually, we've done an income test. You can't keep the current lending that you've got, and that the bank keeps that money from the proceeds of the sale, which can be very disappointing because your leverage returns going down because you got less property and less debt, and the objective was to free up cash, and now you're in a worse position with a smaller portfolio and less leverage. And it can be very disheartening for investors that try to do this stuff themselves without making sure that they understand the moving parts in advance. So cross security, yes, if you, all things held constant, can avoid it, great, but understand better rates, better structure, better bankers. There are sometimes advantages to using it.
Financial freedom.
Day 17 of 21 days, we're looking at pre-approval versus pre-qualification. So pre-approval, what is it? It's when you get an approval amount for a lending on a proposed property investment purchase. So it might be, say, $800,000, and there might be a few conditions. You get a pre-approval when you're going to be buying a property in the next 3 months, and you can roll that pre-approval for another 3 months, but you have to make declarations through that. Why do you get a pre-approval? Well, it gives you confidence when you're making offers to know that there's a bank in behind there that's already done the testing to show how much you can afford, and that they'll back up that offer with finance. Should be working with a mortgage advisor when you get a pre-approval. They will help you pick the lender that's going to give you the most money and the right conditions. And it might be they go to your current bank, but it might be that they go to another bank depending on your situation. You do a mortgage application, complete a profile, submit documentation, and then get a piece of paper that says under these conditions you can borrow money. And you can just do this from the comfort of your own home. Now, pre-qualification is another thing altogether. If you want to buy properties and you're just not sure you're going to buy in the next 3 to 6 months, what you want to do is understand what is your borrowing power, and a mortgage advisor will help you figure that out too. It's when you're getting basically an indication, hey, if you find the right property, we think you can borrow this much. And the reason that you just focus on getting a borrowing amount rather than a pre-approval is you don't have to worry about documentation or credit checks. Don't have to necessarily focus too much on the time limit of that approval. You're focusing on finding the property and then getting the finance. That's pre-qualification. Pre-approval was getting a finance approval and then finding the property. Now, each of these has its merits. If you're a property investor, I think pre-qualification is the way to go. You might be constantly looking at property listings and opportunities and thinking that every 1 or 2 years you're going to buy something. You don't need to have a pre-approval for that. Having what's called a live offer, when you've got a seller and purchase agreement, you've made a conditional offer, or you've at least got the sale and purchase agreement and you want to make an offer, that provides the advisors and the bankers with a lot more encouragement to process your application than, say, what a pre-approval does. Pre-approval is an indicator of interest, but it's not a property transaction. And bankers and advisors are working with a lot of people that don't end up taking action. So sometimes there's not that much excitement to get a pre-approval done. So throughout the process of pre-approval or pre-qualification, there's going to be disclosure requirements. What's your income situation? How many dependents do you have? Cars, expenses, things like that. And you have to understand that if you have a change in your position throughout that process, it's going to change your borrowing power. So the common joke in the industry is somebody gets an approval, and then 5 months later they go to buy the property and they're going to go into bank to settle and open a bank account, but the missus is pregnant and that wasn't on the original application. So that can create problems. So just understand that 6 to 12 month planning ahead is important, and disclosing that to the bank or the advisor is important. There's generally no cost to either of these models, but only the pre-approval has the credit check. Timeline we've talked about, and always a live view is going to help. Understanding that if you're getting a pre-approval without looking at a particular property, there's not going to be that much interest. So having a property in mind is a great way to engage interest from your advisor and your bank. And if you don't have a property in mind, you really have to question why you're getting a pre-approval right now.
Financial freedom.
Day 18 of the 21 days of property investing, we're looking at how to find the perfect property. Find the perfect property is like panning for gold. There's a river of opportunity constantly flowing by, and that if you think about panning for gold, there's little flakes of gold. So you have to sift through some of the crap to find the right deals. And that if you're not looking at property filters that have a lot of opportunities in there, so let's say that in any given suburb or regional area, there's 500 properties listed, your filters should be giving you 100 opportunities to look at. You're cutting out 50, maybe even 75 of them quite quickly, and you're getting yourself on a weekly basis 5 opportunities that you can make offers on, and you're trying to get one of these under contract. If you're only looking at 3 to 5 properties and you're trying to find that one that's perfect, it's not enough opportunity for you. Having a bigger funnel from the beginning and then narrowing down your criteria is going to make things like filtering and sifting through to the right opportunity even easier. Remember, we're looking for a property that has a discount and has a value-added opportunity. And this, you want to get to a process where you're trying to automate this or building up information. So if you can have data that's 3, 6, 12 months around property sales based on land sizes and bedrooms and schools, and you can start getting really sophisticated on your suburb knowledge or property type knowledge, you can build up a spreadsheet, and you might even start engaging, say, an overseas virtual assistant to build up a spreadsheet for you, and you can collect information, getting to a point where they will show you how much to offer and what properties that you should be trying to put a contract in. So the sustained and continuous effort is what's going to help you get the discounts of 50, 100,000, 200,000. You want to be looking at property listings that are inside your budget and then basically making a lowable offer on them. And the thing to keep in mind is that if you're spending an hour a week on making offers and reviewing property listings, and you're able to get a property under contract with $50,000 of profit in it, so an hour a week for a whole year, and you make $50,000, that's $1,000 an hour work. So you really got to find a way to dedicate the energy into it. And if you're spending, say, $30 an hour on a virtual assistant overseas to collect information and process it for you, it really is worth that investment and setting up that structured process. This is something we'll go through in a lot more detail in the Property Formula workshop, so you can have a look at some of those details below.
We understand that finding the perfect property is about looking at a lot of opportunity, filtering it down, and making offers.
Financial freedom.
Day 19 and 21 days of property investing, we're looking at how to pay your mortgage off faster in record time. So the two things that are going to help you pay the mortgage off faster is lower rates and higher repayments. Don't get caught out on all the bullshit and other special ways to pay your mortgage off faster. Lower rates, higher repayments, those are the two high-level things you need to focus on. And that understand there are products that are going to help you do this: revolving credit, offset, and lump sum repayments. You really do need to learn about those options and figure out, based on your money habits and your understanding, what is the right thing for you. Typically, what I want to do in my life and what I suggest to clients is maximize my options. I don't want to overcommit to, say you get a 30-year mortgage, you want to pay it up in 20 years. Why would you sign up for a 20-year term, sign up for a 30-year term, and then make lump sum repayments annually or make extra contributions through revolving credit? This gives you the optionality that if you change your mind, or if you have a break in your income or other investment opportunities come up, that your commitment is to a lower monthly repayment. A 30-year monthly repayment is much lower than a 20-year monthly repayment. You can still pay the mortgage off in 20 years through those extra commitments you're making at the end of the year with lump sum repayments, but you've got the optionality. So don't overcommit and have money for emergencies. Some people want to pay their mortgage off super fast and then they don't have enough cash. Then they end up taking other debt through Q cards, personal loans, credit cards, and it defeats the purpose. They get help sleeping at night by having a shorter mortgage period, but their other finances are a mess. So give yourself options and use interest-only terms where you can, and then the extra lump sum repayments if you don't have other opportunities to invest. You want to focus on your income rather than trying to perfect your mortgage strategy. A lot of people have a grand idea about using revolving credit to pay their mortgages off faster, but they don't stick to the habits. I think a better use of your time, rather than trying to understand revolving credit and keep focusing on that, is focus on skill building and earning more income, because that extra surplus income is going to be a better return on your time, and you can contribute to those lump sum repayments and more property investments as things go on. So all of these mortgage paid courses, they're going to show you cute ways to use these different products, but remember, you want to get the lowest rate that you can, and you want to manage your repayments in a way that gives you a lot of options. You can pay your mortgage off fast, just pay more into it on the principal each year. But if we're serious about building a property portfolio, we're going to build up our asset base before we focus too much on paying down the debt.
Financial freedom.
Day 20 in the 21 days of property investing, we're looking at what is the best mortgage structure. Now, this is a bit of a trick question because it always depends on your situation. What you've got to be careful about is taking too many outside opinions from other people, because they don't understand your situation in full. So when you've got questions like how long do I fix and how much should I fix, it's going to be dependent on what your plans are and what your current situation is. Taking an assessment of the interest rates of the day is an important consideration. You're going to see advertised rates, and then you're going to get rates that you get provided privately through emails or through apps, and you're going to have to take into account what you've got like forecast for yourself over the next couple of years, and often the bank is going to try and nudge you in a certain direction. There are certain periods of time where a 1-year rate or a 5-year rate makes a lot of sense. Certainly when you go back a few years ago, there was a 5-year interest rate for 2.99, which upon reflection is a really great rate that would have been a good thing to fix in for a long term. But you also have to understand at the same time there was a 2.19 rate. So you have to weigh that up. And that's why when you're considering whether you should be fixed or floating or under what portions, that interest rate averaging is usually something that a mortgage advisor is going to suggest. And that's when you break up your mortgage into different sections, and that helps you get over the waves of the ups and downs of interest rates. Obviously, this means that you miss out on the full benefit of the lowest rate of the day, because you're fixing in your interest rates at different portions on different rates, but it also reduces your the impact to a loss if interest rates drop, or if they go up. So you're trying to manage that volatility. So where interest rates go up and down over time, interest rate averaging is when you smooth that curve out. So there's going to be a lot of chatter from economists about what interest rates are doing. You have to take into account that the economists that do reports out of the bank, they're getting information from institutional and kind of banking contacts, and the economists that don't work for banks are usually, there's other things in play. They're trying to stay relevant, they're trying to sell subscriptions, they're trying to get into the media. Sometimes the economists work for other people that can cloud their judgment or influence the things that they're saying. So you have to weigh up all of these different things and kind of make a judgment for yourself on what is the best thing. And instead of trying to time the market with interest rates, it's better to give yourself the most options, and that's what interest rate averaging does. So let's say you have, say, a $400,000 mortgage. It might be that you're taking a third of that on $200,000 and then breaking up the other two portions into $100,000 on 2 years and $100,000 on 3 years. So there'll be some on 1 year, some on 2 years, some on 3 year interest rates, and that allows you to have flexibility. That means if you end up selling your house 18 months into that journey, that you're not going to get the full cost of break fees from the whole mortgage. It's going to be broken up. So the things that are going to impact interest rates that are not as predictable are things like wars and market crashes, and that's why trying to time the market perfectly, I'd say if you're trying to time the market, focus on timing the market on property investment rather than trying to get the absolute best interest rate by timing the 1 year, 2 year, 3 year fixed rates. Fixing in for a long term is a riskier bet because of the higher break costs associated with it, but it does also allow for you to protect yourself on having an assurance on the cash flow side of things. So taking advice on how long to fix and how to structure your mortgage is from somebody who understands your full statement of position, financial advisor, mortgage advisor that knows where you're at today and what you've got planned in the future. And also remembering that plans can change. So minimizing that extra break fee cost by having the interest rate averaging sometimes is the way to go. Taking advice from agents, bankers, lawyers, uncles, take it with a grain of salt. And the only time you really wouldn't want to be looking at interest rate averaging is when you're looking at an equity release sometime soon. There would be a refinance or restructure. When you're taking into account break fees. So if you're going to sell your house in the next year or two, you want to give yourself optionality with shorter interest rates. And if you've bought your first property in the last year or so, you'll probably be, if you've had less than 20% deposit on a low equity margin or low equity premium, which means you're building up to that magic 20% equity, which will get you qualified for the lower rates. But in terms of the best mortgage structure, often it's not from the interest rates, it's going to be from the special products like revolving credit and offset. And so, just protect yourself on the downside rather than trying to focus on getting the absolute best rate with a shorter term, is getting some rates locked in for the longer term and focus on the property investment journey rather than trying to focus too much on the mortgage side.
Financial freedom.
Day 21 of the 21 days of property investing, we're looking at avoiding risk whilst investing. Now, the thing you need to remember is that if we are investing, there's no risk-free investment. Otherwise, I wouldn't be investing. So we don't have to pretend that there's no risk. We have to embrace it. Remember that we're creating out financial freedom for ourselves, and that comes from income. And that income will come from assets. We need to buy those assets. And if we're using a bit of debt to buy those assets, there's going to be an element of risk. But even when you buy assets without any leverage, there's still risks in owning those assets. So the thing that gets people caught up a lot is when they wait for the right time. I started talking to people about their mortgages and property investing in 2015, and there was a lot of people waiting for the right time. There's never a perfect time to invest, and waiting for that right time gets you in this mentality of waiting, and you're not taking action. So the thing I like about property investing is that the safe as houses saying really does hold true. There's nothing that really compares to housing as a an easy type of investment to get into for most people, and that has been around since we've needed shelter. You can only imagine that we're going to continue living in houses for a very long time. That's why it's such a popular thing to invest in. And then in terms of risk versus reward adjustment, housing is just the bee's knees when it comes to risk versus reward. Sometimes you got to make sure you're not overpaying, but other than that, you're getting a bit of a leveraged return, you're getting a steady income stream, and you own the land, which means when the property is finished being valuable, you can demolish it and start again, or you can fix it up. So the thing that's going to get you caught out on the risk side of things when you're investing is if you bite off too much. So if you try to over leverage and then you can't afford that leverage, interest rates go up or some income from those assets stops coming in. So you're going to think about your downside protection either through insurance or partners. If you're doing gut-based investments and emotionally investing rather than using the numbers, if you're not managing your risk, if you're not thinking what's going to happen in the future, in the banking parlance, we call that mitigation, risk mitigation. That might be from extra income that's coming in that's not used for the calculations. If you're trying to DIY too much of it yourself, take into account that renovations, a lot of the work, you might think you can do it yourself, but it might end up costing you a lot more time and money that would have been to just pay a professional. And it's the same with the professional services side of things. Mortgages is one of those things that you can do on your own with the bank, but sometimes you don't realize what you're missing until it's too late to get back what you've missed out on. The knowledge side of things is something that compounds. So if you want to do investments that you're not sure how to do them, try to partner up with someone that does know how to do them. Even if you're giving them most of the profit on the first couple of deals, you're learning a skill that you can apply in the future without them, and then you can take the profit yourself. If you really want to level up and take those next steps, I can highly recommend the Property Formula Workshop. It's a course with 90 plus videos. It goes into a lot more detail than we've covered in the 21 days. You're going to see insights and case studies on how to make $50,000 or $100,000 on one deal and get yourself more confident with spreadsheets. So check out the Property Formula Workshop and pick up the 3 Property Formula book if you want to have more detailed written analysis on how to take the next step with your investing. Investing is not without risk, but if you want real rewards over and above just your day-to-day income, and you want to reach that point in your life when you do have financial independence, you will have to put your money into assets.
Financial freedom. Financial freedom. Oh yeah. Financial freedom.